Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 1 of how beta impacts your investment portfolio's risk and return. Ever wonder how market ups and downs affect your investments? The beta coefficient can help you understand that. It's a measure of an asset's risk in relation to the market. In simple terms, it tells you how much a stock moves compared to the market. Investors use the beta coefficient to gauge how a stock might react to market changes. A beta greater than 1 means the stock is more volatile than the market, while a beta less than 1 means it's less volatile. So, how does this impact your wallet? Knowing a stock's beta can help you make smarter investment choices, balancing risk and reward to better manage your portfolio. Stick around to see how mastering the beta coefficient can save you money and stress. Understanding beta coefficient. In the world of finance, the beta coefficient is a crucial metric that measures an asset's volatility in comparison to the market. Understanding beta can provide investors with insights into the risk and return characteristics of a particular investment. Let's delve into the calculation and interpretation of beta values to shed light on how this metric influences investment decisions. Calculation of beta. The calculation of beta involves determining how an asset's price moves concerning the overall market. The formula to calculate beta is straightforward. Covariance of asset returns with market returns. Different beta values signify various relationships with the market. A beta of 1 indicates that the asset's price tends to move in line with the market. A beta greater than 1 suggests the asset is more volatile than the market, meaning it has higher potential returns but also higher risks. Conversely, a beta below 1 implies the asset is less volatile than the market, offering potentially lower returns but with reduced risk. Interpretation of beta values. Beta above 1. If an asset has a beta above 1, it signifies that the asset is riskier and more volatile than the market. Investors can expect higher returns in favorable market conditions but should be prepared for larger losses during downturns. Beta below 1. When an asset's beta is below 1, it indicates that the asset is less volatile than the market. While this implies potentially lower returns, it also suggests decreased risk compared to the overall market. Such assets can provide stability to a portfolio in turbulent market conditions. Beta equal to 1. A beta of 1 means the asset's price movement mirrors that of the market. Investors can expect returns in line with the market average, offering a balanced risk-return profile. By understanding beta values and their implications, investors can tailor their portfolios to align with their risk tolerance and investment objectives. Beta provides a valuable tool for assessing and managing risk in the dynamic world of finance. Beta coefficient in investment decisions. Understanding the beta coefficient in investment decisions is crucial for investors looking to assess risk and potential returns. Let's delve into the key aspects that connect beta to your investment portfolio. Relationship between beta and portfolio risk. When it comes to investment decisions, the beta coefficient serves as a vital tool to gauge the risk associated with a particular asset in relation to the market. A beta of 1 indicates that the asset's price will move in line with the market, offering average risk. A beta higher than 1 signifies higher volatility compared to the market, signaling increased risk. On the other hand, a beta lower than 1 indicates lower volatility and potentially less risk compared to the market. Therefore, by analyzing an asset's beta coefficient, investors can evaluate how it may impact the overall risk level of their diversified investment portfolio. Impact of beta on expected return. The beta coefficient not only unveils the risk level but also plays a pivotal role in determining the expected returns on investments. Assets with higher beta coefficients tend to promise higher returns but accompanied by increased risk. Conversely, assets with lower beta coefficients may offer lower returns but with potentially lower risk. By incorporating assets with varying betas into a portfolio, investors can tailor their risk-return profile to align with their investment goals. This blend of assets with different beta coefficients influences the expected returns of the portfolio, ultimately shaping its performance in the dynamic market landscape. Investors leverage beta coefficients as a compass to navigate the complexities of the financial realm, making informed decisions to balance risk and return in their investment endeavors. By discerning the relationship between beta coefficients and portfolio risk and understanding how these coefficients impact expected returns, investors can craft a diversified portfolio poised to weather market fluctuations and pursue their financial objectives. Understanding beta is essential for investors who want to manage their portfolio's risk and return effectively. Beta measures a security's sensitivity to market movements, providing insight into how changes in the broader market can impact individual investments. A firm grasp of beta can help investors construct a portfolio that aligns with their risk tolerance and investment goals. Beta is a statistical measure that compares the volatility of a security or portfolio to the market as a whole. It is derived from regression analysis, where the price movements of a security are regressed against those of a benchmark index, typically the S&P 500. A beta of 1 indicates that the security's price tends to move in tandem with the market. A beta greater than 1 suggests that the security is more volatile than the market, meaning it is likely to experience larger price swings. Conversely, a beta less than 1 indicates that the security is less volatile, with smaller price movements relative to the market. One of the primary uses of beta is in portfolio construction and risk management. By understanding the beta of individual securities, investors can estimate the overall volatility of their portfolio. High beta securities are often associated with higher risk and the potential for higher returns, as they are more sensitive to market movements. Low beta securities are typically seen as less risky, offering more stable returns but potentially lower growth. Investors looking to optimize their portfolios must balance high beta and low beta assets to achieve their desired risk-return profile. For example, aggressive investors who are comfortable with higher risk may allocate a larger portion of their portfolio to high beta stocks, aiming for greater returns. On the other hand, conservative investors might prefer a mix of low beta stocks and bonds to minimize risk and ensure more predictable performance. Diversification is another critical strategy that can benefit from an understanding of beta. By including assets with varying betas, investors can reduce the overall risk of their portfolios. When high beta and low beta assets are combined, the portfolio is less likely to experience extreme volatility, as the different reactions to market changes can offset each other. This approach helps in smoothing out returns and providing a more balanced investment experience. However, beta has its limitations and should not be the sole factor in investment decisions. Beta measures only market risk, not company-specific risk. A stock may have a low beta, indicating low market-related volatility, but still possess significant company-specific risks, such as management issues, regulatory challenges, or competitive pressures. Therefore, investors should also consider other metrics and conduct thorough fundamental analysis to gain a complete picture of an asset's risk profile. Another important consideration is that beta is based on historical data and may not always predict future performance accurately. Market conditions, economic environments, and company circumstances can change, potentially altering a security's beta over time. Investors should regularly review and adjust their portfolios, considering the current beta and any changes in the underlying market or economic conditions. Moreover, beta can be influenced by the time frame used for analysis. A stock might have a different beta if calculated over a short-term period compared to a long-term period. This variability underscores the importance of using consistent timeframes and methodologies when analyzing and comparing betas across different securities. In addition to individual stock selection, beta plays a role in broader investment strategies. For instance, tactical asset allocation involves adjusting the portfolio's exposure to high beta and low beta assets based on market conditions and economic forecasts. During periods of expected market growth, an investor might increase their exposure to high beta assets to capture higher returns. Conversely, in times of anticipated market downturns, shifting towards low beta assets can help preserve capital and reduce risk. Beta is also a crucial component of the capital asset pricing model, CAPM, which is used to determine the expected return of an asset based on its beta and the expected market return. According to CAPM, the higher the beta, the greater the expected return, compensating investors for taking on higher risk. This relationship helps in setting realistic return expectations and aligning investment choices with risk tolerance. Understanding and utilizing beta can significantly enhance an investor's ability to manage risk and optimize returns. While beta provides valuable insights into a security's market-related volatility, it should be used in conjunction with other analysis tools and metrics to make well-rounded investment decisions. Regularly reviewing and adjusting the portfolio based on updated beta values and market conditions can help maintain the desired risk-return balance, ensuring that the investment strategy remains aligned with the investor's goals. By effectively leveraging beta, investors can navigate market fluctuations with greater confidence and achieve more stable, long-term investment success. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.